strike price and the cost of the stock, which is $3.
So before it's 3 is 77.
Right, so it's 77.
Basically, the most you can make in that scenario is the 75 plus $2. Right. That's your cap.
Right. So you're making you bought it at 72, the most you're going to make is $5. Okay?
Because you have to
That's
subtract
question
the,
because
you
it's
have to
not
subtract
an
the
easy
$2 per.
concept to. What was that?
You have to subtract the $2 per share that you put up to have the option, or to buy that option, right?
No, in this
In
case.
this case, you're
Oh,
selling.
for the
You're
seller,
selling,
seller, right.
Yeah, in this case,
So you
you're
have to
selling.
give that, right?
Right.
Gotcha.
Now, if the stock drops to $69 and your cost is $72, but you have the $2 of premium, right? So that's going to offset your loss. So now your cost on the stock is $70. But the current price of the stock is at $69, right? So you have a $1 loss. So here again, selling the calls has helped offset some of your loss. And then you're free to now go ahead the next month and do the same thing. Any questions? Okay. Well, I just wanted to point out here that, so, if we go back to that, earlier big chart, the big picture, you can see that, during these periods where the market is relatively flat, if you're buying here and just going to hang on for the long haul, that selling these calls, you would have more than paid for that stock probably in this period of 10 years. Okay? Now, put options. Put options give you the right to sell the stock at a specific price over a specific time. Okay? So let's go there. So here again, we go back to, the holder of the put, he's under the pressure of time as the buyer. The seller is cool, calm, and collected because he's just waiting for time. But the buyer, here again, is fighting the clock. But here again, he has the right to sell the stock to the buyer. And the buyer's got the obligation to buy. The writer has the obligation to buy. Okay? So now we go back to our house example. The homeowner in this case wants to, because the market is, starting to look like it's acting funny. He's going to buy a option from this option seller for $10,000. He buys it for $10,000, right? And if the house drops below the $100,000, right, then this guy has to buy the house from him for $100,000. Okay? Now, so in this example, if the value remains above the $100,000, this guy walks away with $10,000 profit in those 30 days. Okay? Because the value of the home has not gone down. And the marketplace out here, he's got a marketplace now that, where he can easily sell it for above it, if he has. Okay, any questions? Let's go to the answer. now in this example, the house price, here again, he's, buying the right to sell the stock, sell the house for $100,000 if the value drops. So the option seller, the option seller now is going to get the $10,000. Okay? Now, in this example, if the house drops below the $100,000, he has to pay the homeowner the $100,000. Okay? So the option seller, is ending up buying the house now for $90,000. Okay, because he has to subtract the $10,000 he paid plus the $100,000 that he has to pay the homeowner.
This is for you BP buyers, right? British Petroleum, you guys that bought it, right? You bought it at 55 or so, and if you had bought a $55 put option, say that was good for 60 days, and thing blew up like it did, and stock dropped down to 26. You could have sat there, okay. Say that happened the first week of your option period. You got what? Maybe 5 weeks or so that you can sit there and wait and see what's happening, right? Stock has dropped from 52 down to 26, and anytime over that 5-week period, you can get online, call your broker, sell my shares for $55. And whatever you paid for that put option, right, that's the insurance for it. So you don't have to necessarily set and just take losses if you have options. Put options, the insurance.
Okay, let's go to the next. Now, here's a good example of why you would want to buy a put. This is, I think, Google. When they report earnings here, they took a big hit. Right? You can see how much the price dropped. Now, if you had a put option that you had bought, you would have been protected. But you see where you went from here all the way down to here, over 100 points. So this is a good example of why you would want to buy a put option. Okay. Okay, now, the only difference between the call option options chain and the put options chain is the P. Right, in the symbol. The last sell price, the previous date, all of those things are the same. But when you go through the options chain table, you're now going to be looking at puts, and you should see a P in the symbol. And that's the only difference. But everything else, the meaning of them is the same. Now, the other thing that's a little different here is that with puts, as you go up in the strike price now, you're in the money, right? Because the value of the put options, the higher you go in price, because the stock is not there yet, you're going to pay a higher premium. Right? The lower the strike price, because the put is above that, you're going to pay a cheaper premium. Okay? So, and here's an example. I mean, if the stock right now is trading at 15, and this is where I was telling you about, like with Citigroup, you might want to sell some of these 13s and 14s, because what's the probability that it's going to drop that low? If you want to buy the stock, right? If you want to buy it, you're going to buy it at that new price. questions?